It goes a little bit in cycles, like the economy. Banks and non-bank institutions go into trade finance, getting a little bit of capital deployed, and then something blows up. Whether it's grain sale or it's Stand or a lot of other companies that we've heard of and we've seen.
And I'm going to focus on the securitization framework, which unfortunately, because of the global financial crisis, was subject to, if people who are familiar, the framework was a patchwork of rules. There really was no framework.
Welcome to Trade Treasury Payments, the podcast unlocking the future of cross-border finance.
From transaction banking and money movements
to liquidity, treasury, and cash management.
We bring you expert insights and the latest trends shaping global finance.
Well, good morning, everyone, and welcome to the Lansdowne Club. Thanks so much for joining us on an early morning on a Wednesday morning. I'm Joy McKnight, Transaction Banking and Payments Editor at TTP. It's been 6 months since the inception of Trade Treasury Payments in April, and we've come very far, very fast. Here are a few highlights since our launch. We've published 449 pieces of content covering 46 markets around the world. We've grown to a global team of 14, operating in the UK, Nigeria, Canada, Belgium, Malaysia, India, and the Philippines. So very international. We have a 56-person global advisory panel who are critical in ensuring that we deliver timely and accurate market insights every day. We have launched 8 publications, including 3 reports, some of them are here, and 3 magazine issues. We've broadcasted 54 video interviews, 22 podcasts, 3 webinars. And we now have 5,000 LinkedIn followers, averaging about 120,000 monthly impressions, coupled with an average 225,000 monthly organic web impressions. And we've physically attended and reported at 40 different conferences around the world, in every continent from Tashkent to New York, Windhoek to Singapore. Come back from Frankfurt, maybe not quite as exotic as Tashkent, where we attended Sidewalks 2 weeks ago. It was a full-on 4 days, well 5 if you include the Bankers Association for Finance and Trade, or BAF, Global Council meeting the day before Sidewalks began. It's great to be back in London, and I'm almost recovered. Today our Breakfast Club is all about sharing some of that enormous knowledge base with you. This morning's panel will be debating how to make trade finance assets a more attractive investment. And I wrote an article in 2016 on this topic. And from the outside, and for those that are proponents, it seemed to me like it was a no-brainer. As an asset class, trade finance has a number of strengths, including its stability, limited correlation to the markets, and low default risk. Yet almost a decade on, and I would say it hasn't changed as much as people had hoped. So today we'll be looking at how we scale trade finance as an asset class and the role different parties, which is banks and non-banks, can play, the role of private credit, structures that support small and medium-sized enterprises down the chain, and how to engage corporate treasurers into the world of trade and supply chain finance. Alongside our expert views, we'd love for your input. Once again, thanks so much for joining us. We hope you enjoy it, and please make the most of this opportunity. So now I'd just like to introduce Jeff Wynn, moderator of the panel. Jeff is head of Sullivan's Trade and Export Finance Group and the firm's London office. Recognized as one of the leading trade finance lawyers globally, he advises many of the major trade finance banks and financial institutions around the world on trade and commodity transactions in virtually every emerging market. Over to you, Jeff.
Welcome to all of you. Making trade finance assets a more attractive investment, as Joy has said, would sound like a no-brainer. We have a trade gap, unfinanced trade of somewhere between, 1.5 trillion and 3 trillion. So what's holding everybody back? Is it
People don't understand the asset. Should we explain what the asset is? Is it the quality of the asset? Do you know what you're likely to get? Is it the veracity of the asset? We'll probably come on to that. Or is it just the mechanics? How can we do it? We have assembled here an interesting and, if I might suggest, a slightly disparate panel. So in other words, you're not going to hear the same people banging on about, I'm a bank, this is what I do. But instead, I hope cutting and slicing what's going on. I'm going to ask each member of the panel to spend just a minute introducing themselves. I'm then going to throw a few points, and then I'm going to ask each member of the panel again to set their views to get you all thinking. After that, we're very happy to take questions or we'll debate. It's all up to you. You will, after the first half an hour or so, you'll control the rest of the session. So without any more ado, let's get started.
Good morning, thank you. Alyssa Rusinov, founder and CEO of the company LTech AI, credit underwriting and fraud prevention tool for lenders, which is probably one of the reasons I'm trying to solve the problem of trade gap. My experience in trade finance has been over 10 years. I run a couple of funds in the space, backed by various types of LPs and asset managers. I was employee number one at a company called Marco Capital, which is a fintech company with LATAM focus, so very familiar with cross-border trade as well. Happy to be here. Thank you.
Sure.
Thank you. Good morning, everyone. My name is NLS Paru. I'm part of HSBC. I know bank is not a popular word here, but
No, but you're selling.
in my day job, I had a few product lines for HSBC's trade business globally, including asset distribution. And I'm also a board member at ITFA, where I drive this topic of developing trade as an asset class. And I'm very excited about the opportunity lying ahead of us. But there are many lessons to be learned on what we have seen in the last 10 years. I've been in the trade finance industry for about 2 decades, and this has been a topic very close to what we have been driving at ITFA and in general as an industry to get more and more capital to finance more and more clients, particularly at the long tail end of what we serve. So very excited to be here and looking forward to the discussion.
Krishnan.
Ramadharai Krishnan, I am the Chief Executive Officer of Global Credit Data Consortium, GCD in short, and often I'm asked, what does your institution do? Well, in short, we are owned by 50 global banks. We are the ones who collect data, crunch the data, and provide the only known database worldwide on loss given default and probability of default across the entire wholesale asset class space, including project finance, aircraft, shipping. We are the ones who provide the data back to our banks. And trade finance, I've been in my earlier job as the head of portfolio management at HSBC. I also chaired the ICC Trade Register and fully familiar. And at GCD, we are the ones who crunch the numbers. So understand trade finance for many years, and I'm happy to be here. And my views may be completely contrary and may not go down very well with many of you, but so be it.
Yeah, Matthew, follow that.
Well, good morning, everyone. My name is Matthew Cox. I'm a partner at the law firm Sullivan & Worcester, so I'm Jeff's colleague. I've been doing trade and structured commodity finance for about 20 plus years, mostly here in London, but also 10 years in Singapore. The clients that we would act for would be either the big banks or the alternative financiers in this space, so some of the specialist funds, but increasingly also acting for some of the fintechs and digitalization clients that are looking at the application of technology to trade commodity finance. And delighted to take part in the panel this morning.
Thanks. Sarah.
My name is Sarah Boyce. I'm from the Association of Corporate Treasurers, and the clue is in the title. So I've been invited, I think, along here today to give you all a bit of a perspective about what trade finance means, or possibly more importantly, doesn't mean for corporates. A little bit about me. So I am an accountant by training, spent several decades working in corporate treasury. And I can explain later what corporate treasury is, because that's always quite a useful thing to do, I think. And then the Association of Corporate Treasurers is a body, it's kind of a trade association that has been around for about 45 years or so. We have over 5,000 members globally. The majority are in the UK. The majority are also working in what I'd call the real economy, in corporates. And my role at the ACT is twofold. So part of it is about gathering market intelligence and understanding what's coming down the pipe at the corporates to help them position themselves and be prepared for what's happening. And the other part, and possibly more of the role that I'm playing here today, is to help the official sector or other parts of the market actually understand what I call the implications of their latest cunning weed or the market plans are actually on the corporates.
Sarah, thanks. I'm going to let you back last after the others have spoken, because you can then come back and retort about what they've said. So
You may not like that.
this is sort of quite unrehearsed, you'll be delighted to know. Picking up Joy's point about what would it take to scale up trade finance, that's what we're, I think, going to try and talk about. One of the questions that I would pose to the panel, just think about it, is what is a trade finance asset? What are we actually talking about here? I coined a phrase years ago called true trade, which was a sort of a sale of goods or services between corporates. Is that what the institutional asset ought to be? And then how would you market to an institution? Have I got true trade? If you all remember, as you probably do, the Wolfsburg report years ago, trade finance is inherently risky, they said. And people like me said, no, it's not, because trade gets paid. So we've got this balancing act between some views that say it's risky to trade actually gets paid. So how secure would you make your trade transaction? How secure are you when you're financing trade? You know, that horrible word fraud, what can we do with it? Is it about structuring, whatever? How can we improve the quality of a trade asset? Is it credit insurance? Is it structure? Do we need the law changed? Do we need to do anything? So those were the sort of ideas that I had. And now I'm going to throw it to the panel to pick all, any, or none of those as they make their comments. We'll go this way round. Elisa, you start.
I guess I'm in a lucky seat today.
Who chose it?
There was a lot of them left. I think it's an interesting topic, and I think it goes. So I'm based in New York, so I forgot to say. It goes a little bit in cycles, like the economy. Banks and non-bank institutions go into trade finance, getting a little bit of capital deployed, and then something blows up. Whether it's Drain Sale or it's Stan or a lot of other companies that we've heard of and we've seen, or the most recent one, which everyone is aware of in terms of corporates. And that kind of brings the investor appetite back to where it was, to square zero. So I think, as you mentioned, the biggest issue is fraud. It's not even credit risk. There's different ways to structure. It is a structured product. People that are working on the product should know what they're doing in terms of structuring the credit, appetite, diversification, concentration. But the way I look at it, wearing my credit hat for many years, there are three types of risks. A, credit, which could be priced in. Obviously, this is how economy works or finance works. 2, fraud, can't really price it in. And 3, operational risks. You can partially probably price it in, or I would say diversify it rather. So fraud risk is the biggest one. And the reason we haven't been able to succeed in the last decades, I would say, right, is because we did not have the technology tools to underwrite and give a 360-degree view on the product. So what field examiners are doing, and I'm sure everyone has experience working with field examiners or auditors, doing underwriting work or in-house underwriting work, they're spot checking, right? So a lot of it is really partially reviewed because it's impossible given the volume, the transactional volume. It's a lot of paperwork. It's not just invoices, it's supporting documentation. And every single invoice could have up to 7, 8 types of supporting documents. Could be a bill of lading, could be credit insurance wrapped around, it could be a letter of credit. So I do think with a lot of innovations in Gen AI recently, AI generally, there is a way to have this asset class as a very successful and a very efficient market. It has not been efficient due to fraud, and that's my true belief. But I do think we could bring it to the semi-efficient level and more efficient level within maybe a decade or so, which basically means that the spreads, and we're seeing that in investment grade markets for sure. Like JP Morgan is giving trade finance receivables the 1.5 point spread annualized. So the margins are really thin on something that could be IG grade basically. But on the SME level, on anything that's below that level, the spread is still there. It's substantial. The non-bank lenders still charge, on average, low to mid-teens. So there is appetite, but everyone understands it's risky. So bottom line, if we are able to tackle the fraud issue, or at least mitigate it up to 90% confidence level, I think we can get that market to be much more efficient.
That's interesting. Bit of innovation, deal with fraud, make it all more efficient. Swaroop, what do you reckon?
Trade finance is a historical business. There's a long history of where trade started. It's not a new business that people are trying to tackle. It's probably one of the oldest forms of financing which existed with humanity. So I think we need to recognize on how trade happens. And I do want to add to the point that goods trade is probably one universe, but the world is moving towards services trade as well. So there's a large play there on the services area which we'll tackle. But coming back to the point on the question you asked, how do you make this more investable? And I was reflecting upon it last night, this morning while coming here. I would say 3 principles have to be followed, right? One is for today, second is for tomorrow, and one is for future. And what are those? What we do today is to scale our existing business, have possibilities of getting more finance, and looking at bringing more efficiency in how we finance today's business, i.e. support greater growth for our clients. So when trade finance is done with clients in serving their treasury optimization, working capital needs, and how do we serve them more? That's serving for today. So any originator or investor has to look to serve the clients, to serve them and help them grow. I think that makes the proposition valuable, and that brings value to both at the customer's end and corporate customer's end, for the originator and for the ecosystem. The second piece that needs to be kept in mind is what you do for tomorrow, i.e. how do you make sure that this is driving growth for them in bringing responsible origination, i.e. how do you make it sustainable for them in terms of driving volumes, putting responsible controls in place, and having good origination principles driving your flow. And the third is how do you build for future, i.e. how do you bring technology and structures which can serve the future needs of either services trade, sustainable financing, embedded financing, all the emerging areas. So I think all originators and investors need to think from these 3 lenses on how are they really developing their products and solutions to serve all these 3 elements, which will drive volume. Underpinning all of this, as was mentioned before, is the technology and structure part, which is basically saying how do we really create structures which are well thought through and really trade structures and not really direct lending or unsecured financing just given out, and make sure that the pipes are correct and you have controls. And this is where some of the examples that are being quoted highlight the fact that there is value in having requisite controls in origination and management of trade finance. And we have learned this time and again. And I know you referenced banks in the beginning, but I do come from the banking community, and I do think banks are one example of how over years infrastructure has been created to manage trade finance and mitigate risk. And there is inherent value in it. And I'm not saying banks are the only place where that can be done, but it is important to recognize that trade finance needs controls and management, and which is why trade becomes inherently low risk, because you have requisite controls. And we have enough examples which have highlighted this fact. That needs to be kept in spirit and not lost. We cannot lose sight of the same. And the third is the technology part, which was referenced, i.e. how do you make sure using technology, whether it's tokenization, AI, or data-driven underwriting and other principles, which can really fasten some of the processes we have in order to do larger, better, and more origination. I think if we do all of this, it's nothing new that we are saying, But we need to do all of this consistently, and more people have to create the infrastructure for making trade finance investable. And that's been the hard part, because there is temptation to jump a few steps or not do a few of these and just get to the investment part, which creates challenges for the investor as well as for the industry. So if we create a good origination pipe with requisite controls and having good understanding of structures and investment, it will create a very interesting, a very good example of what we have launched with our asset management team. And you mentioned earlier event at Frankfurt today, we did launch trade and working capital solution strategy with our asset management unit, which is a separate unit within the bank, but HSBC as the originator can continuously feed assets through our asset management unit for institutional investors to tap into. So that's one example of how you can really bring institutional capital and direct origination together to be able to bring more capital to trade finance.
A lot of common words coming out: volume, technology. Okay, volume play. Krishnan.
Thank you. As I said, mine is a more prosaic, argument I'm going to make. The question is, how are you going to scale trade finance? And I'm going to focus on the securitization framework, which unfortunately, because of the global financial crisis, was subject to people who are familiar. The framework was a patchwork of rules. There really was no framework. And that was addressed by the regulators after the GFC. But unfortunately, with what happened, because the securitization market was painted by the same brush, whether no differentiation was made between US and Europe. And of course, in Europe, many of the banks lost money because they had invested in the securitization market. So the focus of regulation was very much guardrails, safety first. Now, with many years down the line, it's a tragedy that in Europe, there are more reporting requirements, there are more compliance issues, which has been a barrier for securitization. Unlike the US, which had the most losses, yes, they were strict till 2015, but then they have relaxed things. And I'll give you a couple of examples, the contrast between the US and Europe. But what clearly has happened in Europe, and when I say Europe, I'm also including the UK, the operational costs are extremely high for securitization, something like 800 million a year. The reporting requirements in terms of due diligence, both from an originator and an investor perspective, is extremely onerous. Secondly, so there are barriers for both banks as originators and investors, and it does not help, and the market is really not grown. Give you a simple example. Before the crisis, asset-backed commercial paper was the go-to place for receivables, both in terms of single conduits, multi-purpose conduits. Completely collapsed in Europe, has never come back. Okay, there were issues regarding the backstop liquidity lines of AAA. There is a clear case for ABCP to come back, right? Even with the stricter capital regulations, because it just lends itself to receivables. But more in terms of the securitization market, what is changing? There was a lot of push, reporting or due diligence requirements from investors. Now that has been relaxed in terms of verification requirements, reporting requirements, as long as the originator is within the EU. Of course, if the originator is outside the EU, these reporting requirements still remain in terms of due diligence, but possibly we have made some progress. So this is important. Secondly, what they've also done for assets which are like credit cards and consumer loans or automobile or the car loans, securitized, you do not have to give loan level details or reporting requirements, which is important from an originator's perspective. And trade finance possibly can fall into this space, but then we don't have many structured examples of trade finance securitizing. Yes, I know we have C-Lane, some other banks have done it, but on a consistent basis, because the issue came up, how do you scale up? Now, I know securitization is expensive, but the technology, the improvements in technology clearly means that there is a way out here because you can scale up. And particularly the other point made is, yes, you need to provide returns of 10% for equity tranche holders, but when you commingle assets, there is a clear case for this coming back. Now, reporting requirements have also been simplified, and it's amazing. For the first time, the European Union and the PRA, very specific, there has been a reduction of 30%. And in terms of data fields and reporting, both from an originator and an investor perspective, you have the option. They're not mandatory, because when you make them mandatory, it runs into problems. But most important, 3 things have happened. MDB guarantees. When you have transactions which are guaranteed by multilateral development banks and listed public sector institutions, you do not have to do due diligence. You do not have to have risk retention as long as the equity tranche is 15%. Some of you may raise the question, equity tranche of 15%, does this work? Well, I can tell you the risk weight, assuming portfolio default rates of 1%, is 13%. Assuming portfolio default delinquency rates of 3%, your risk weight is still 20%. So it will work. This is a big change. If you look at the IFC CLOs, which have come where the IFC is the first loss holder, this lends itself because many of the MDBs have trade finance programs. I'm just giving you some examples of significant change. The second change, which is more relevant here, insurance companies, when you have STS transactions, which are simple, transparent, and standard, it had to be funded. So the insurance companies could not participate. Even if they had a guarantee, it had to be cash backed in form of either AAA bonds or AAA Treasury. That has been amended. So today, you can get an insurance company guarantee subject to a couple of caveats. The insurance company needs to be regulated under the Solvency II rules. They need to have 20 billion in assets and also have more than one asset class from an insurance. But that's a big game changer, and the question was clearly posed, how do you scale? The insurance companies have been the beneficiaries of the GFC. I told you the ABCP market never came back because the insurance companies filled it. So here's another play. SMEs, coming back to the SME sector. Now, unfortunately, the European Union, when they write their regulations, they can never be simple. So they say SME sectors which are under the STS needed 100 to be classified as simple, transparent, and standard, needed to have 100% of the portfolio to be SMEs. They have changed it to 70%. Effectively, this means you can have 30% of investment grade and you can mix it up to enhance credit risk quality. So that's another change. Whether it moves the needle or not sure, but 70% is a good starting point. And the issue of trade finance gap came up. So that can be done. Now, STS requirements, some of the structural features have also changed, but this does not mean that overnight we are going to see the securitization market come up. But I just thought I should share all this because securitization is an important tool. And when I say securitization, it's not just CLO. It is the asset-backed commercial paper market, which in my opinion needs to come back.
Fisher, that's interesting. So we've got a potential solution, an interesting
challenge. Or maybe get time
after the others respect.
Yeah.
Right, Matthew, you've got lots of clues, structure, use of technology and so on. What do you reckon?
Well, thank you, Jeff. So I guess I come at this from the perspective of a lawyer that spends my day working with clients trying to do commodity finance transactions. And this question of how do you make trade finance assets more attractive is, in a sense, a question that we look at every single time we do a transaction because we're trying to craft those structures to deal with any concerns that the financiers have. And I think Jeff mentioned the trade finance gap, and every time I hear the numbers get thrown out, so I think he said 1 or 3 trillion.
2.5 trillion. I've just done the research.
He's very compromising.
Yeah, there you go. So it's a different number. I always kind of think, well, isn't the trade finance gap effectively infinite? Because there's a kind of almost infinite demand for finance. But obviously, anecdotally, we hear from our clients, so both the banks and the non-bank alternative financiers, there is an appetite out there for them to lend against these assets. That's the full range of the specialist trade finance banks, the specialist trade finance funds, all the way across to funds that maybe don't know anything about commodities or trade finance, but they have internal approval to take some exposure to commodities or take some exposure to particular markets. So the appetite to lend is there, and on the borrower side, the appetite to borrow is there. For those transactions that should be going ahead but are not going ahead, the obvious question is, well, what are the blocks that are stopping those transactions from happening? It seems, from our perspective, a lot of the time it's the fear about the unknown risks, right? So the financiers are okay with taking commodity finance risk as long as those risks can be ascertained and understood. But what really worries them is the unknown risk, that they're sort of coming in the morning and finding that there's been a giant fraud and that the commodity that they thought they were financing doesn't exist, or perhaps has been financed multiple times in a fraudulent manner. So I think there's lots of sort of traditional mechanisms for trying to deal with those risks and close that gap. We always say that when you're looking at the security, we always break it down into the different asset classes, and we look at the whole of the commodity cycle. So you start with the physical inventory. When that is sold, it's turned into a receivable. When those receivables are paid, it's turned into cash, hopefully in a collection account. And if you just look at the way of trying to make that security structure as robust as possible, you can then try and make that trade finance asset class much more attractive. I think quite a few of the panel have been mentioning technology coming to the rescue. So I did just want to address that, because this is an area that we're looking at quite closely. Over the years, we've been acting for the fintech industry and entrepreneurs that are looking at digitalization of various trade finance assets. So digitalizing bills of lading, warehouse receipts, bills of exchange. The obvious attraction of that is you have a digital instrument that is clearly, in theory, that having that digital instrument takes away a lot of the fraud risk, because you can't multiple finance digital assets in the same way fraudsters have been able to use the paper-based systems to do those kinds of frauds. The challenge has always been that it's very difficult for one particular institution to go digital, because you need the whole of the ecosystem, all of the shipping company. You need your shipping company, you need your financier, you need your insurer, you need your port authorities to all go digital at the same time, which has always been the challenge. But I guess my view is an optimistic one, in that I think the fintech industry and the digitalization industry is throwing serious money at trying to develop these technology products. And it does seem to us that this time is different. I know there's quite a lot of pessimism in the market, and maybe in this room, maybe a bit of eye rolling when you start talking about digitalization, as we've heard this before. It didn't happen before. Why is this time different? But I think if you look at what's happening around the world, the governments are passing legislation specifically designed to support this transition. So the most recent one being the French, who just passed the equivalent of the Electronic Trade Documents Act. And then in the market, we have seen real trades involving these digital assets. So one that's public is ING and Trafigura just used an ICE digital bill of lading in a borrowing base transaction. That's a relatively small thing, because it's an existing structure, and the use of the digital asset is just making that structure just a bit more efficient. But that's a real world transaction that's public. And I think once those institutions get comfortable doing that, you can see how that could spread to a wider section of the market. And one day, when everything's digitalized, when every warehouse has cameras monitoring the stock in real time, and the warehouse receipts are all digital and on a platform, then all that risk will have gone, but trade finance some of the fun will have gone too, right? I mean, trade finance will just be as straightforward as doing real estate finance.
Can we take the fun out of trade finance? Right.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it.
Sarah, you've heard all this. you represent the creation of the asset class. That's what this is. And this is what this is aimed at. And the magic word that Krishnan used, you create the receivable. What do you think?
Where to start? Yeah, so it feels to me very much as though there's a supply and demand basic economic question going on here, and that there's the demand for the asset from investors. You need the corporate, bluntly, to be the supplier of those assets. There's a real challenge that corporates, so where corporates come from is that, and particularly in Treasury, and I'll talk about what else Treasury do and help you understand why this is so peripheral for a lot of people. But fundamentally what they're trying to do is they come from a position of, does this solution solve a problem that I have? And if it doesn't solve a problem that I've got, to be quite honest, I have a lot of other problems that I need to solve first. So thank you and good night. So quite often with things like trade finance, you don't even get a foot in the door because the corporate perception is that they don't actually need this product. And that's another question is, what do you mean by trade finance? There's a massive education gap in that, do you mean supply chain finance? Do you mean you securitizing things, asset-backed commercial paper? There's all these terms to get thrown around, export credit guarantees, the list goes on and on, you guys know it far better than I do. For a corporate, all of that noise, the immediate reaction will be, do I actually need to do any of this? I don't understand it. For the avoidance of doubt, and particularly when you read the media, whether it's this week, last year, whenever, for the avoidance of doubt, I won't do it because if I don't do it, I'm not wrong. I don't see the benefit of using this product. So there's a huge education piece about, if all of you want to be scaling the asset class, you need to explain to the people that are going to create the asset why they should, I'm going to use the word bother, but bother. I think I might stop here. Let me just see if I've got anything else useful to say.
I love it. You've just given me some fantastic notes. Swaroop in particular is listening because of the need to educate.
Yeah.
I love this because this question that the corporate says is, you've got this great solution, do I need it? What's the problem? Because I think, to me, that's been part of what's going on. There's been this huge idea that I've got a solution for you, and you're saying, well, actually, do I care?
Yeah,
and with all due respect, Matt, to the example you gave, they played with a solution because they were doing the business anyway. Do you want to say any more while you're doing that? Swaroop's dying to say something. So.
I had interjection for him, but I have a point for it, but complete your point.
No, crack on.
No, I completely agree on the origination. This is where I started, right? And how do you drive origination? And I spoke in terms of trade finance originators, but what that effectively means is, how do you serve the corporates? And how do you create value for clients by giving them trade finance? And the conversation has got really elevated in the last few years. So I do actually want to emphasize that many treasurers now see value in trade finance. It was exactly like that. When I started doing trade finance, we used to be at the operating level, not at the strategic level. But in the last few years, the conversation has shifted. And the drivers of that is working capital optimization is becoming more and more important for treasuries. You're looking to develop resilience in your supply chain. How do you bring cost of capital down? So it's becoming more, and some of the events, whether it's COVID or recent crisis with all the tariffs, has really brought this into spotlight. So I think in adversity, there's always an opportunity. So I think that has really catapulted trade finance into the boardrooms now.
Yeah.
So I think the conversation now is really about how treasuries and companies can use this as a strategic tool to drive growth. And this is where all originated. This was the first principle that I was talking about on driving origination. How can you do bigger, better, faster for trade origination? I think that's the principle which I fully understand sentiment.
Just want to add to Sarah's point, if you don't mind. I think Sarah made a very fundamental point. The treasurer doesn't care because trade finance, as Swaroop himself said, is part of working capital. They look at it as a part of working capital solution. And there's a point here, because we talk of trade finance when I say we, the banking industry, trade finance as an asset class. I'm sorry, Basel does not recognize. We have been here before, and they've said there is no case for this. This is part of corporates as an asset class. This is part of working capital. And till we understand that this is only a sub-asset class, you can try your luck. This was done in 2014. It was kicked out by the Basel Committee. It's an important point, because we keep going on and on and on about trade finance as an asset class to be treated separately from a capital. It's not going to happen.
No, I think the point is not about capital, Krishnan, but since you brought this up, the earlier point, the challenge, and this is a question for you actually when you spoke about securitization, there are many examples. Does securitization directly lend itself well, particularly for the full spectrum of trade finance, is an important question. And how do you come around the issue of replenishment and cost,
Correct.
Particularly at the transaction level?
I agree.
ABCP and securitization is all good, but I think we almost need a halfway house between traditional securitization and trade finance techniques for it to serve well.
Yeah.
You know what that is?
Trade finance is not an asset class, Basil says, but trade assets can be made more attractive.
Yes, that is better. That's all I'm saying.
Okay,
Jeff.
that's fine.
So,
Sorry.
otherwise there's confusion.
I think the middle ground between what you guys are saying is embedded finance. And this is where I see the real appetite is, because it does help you mitigate fraud risk. And embedded finance could have multiple channels of distribution ways. Digital banks, ERP systems, or accounting platforms. There has been multiple instances of successful implementation in the US when Oracle, NetSuite, and a couple of other ERP systems do provide that. And there is a lender on the other side. There's credit cards, there's MasterCard, there's American Express, do different types of supply chain programs. So the embedded finance with a white label solution with an LP or like asset manager or any kind of lender at the back end, or a bank at the back end, I think is where the future holds. I do agree that trade finance is not going to be an asset class, but I do think it's going to be a blended working capital solution through technological integrations that does help the user interface, it does help the user experience, and it's a flow that does mitigate fraud risk as well. Oh, we agree on something.
Absolutely.
I completely agree. It's a working capital solution. It's the point that you would be making actually in various ways. It's a solution. If you can position it as a solution for that problem, then it becomes useful. When you start talking about it in the abstract, that's great for bankers talking to bankers, and the real world really doesn't care.
Now keep going. This is exactly what I wanted you to talk about, because it was your comment that it's a bit like, do I need it? So you've got this huge solution, and it's not addressing what I really need.
And that's where people like HSBC play such a useful role for corporates, is that they can actually identify what part of the whole range of the assets that you guys are all playing with is actually relevant for the corporate and can implement that piece. And I think a slightly different point, but whilst I remember it, because my brain is like I said, there's a point as well about it's very easy to think about trade finance for SMEs or for what I call trickier companies. We spend a lot of our time working with the very large multinationals. That's my background. And back in the day, we didn't need or use trade finance solutions at all. Everything was open account. And you're absolutely right, particularly post-COVID, people are re-examining how they can operate more efficiently. But there's nothing wrong with open account from the perspective of a lot of corporates. And you need to be able to position this as a better solution for them, because the more noise that you add to any product, and I was talking to somebody before we started this conversation, and we were talking about KYC. And for corporates, KYC is just like the worst thing ever. It's the biggest pain in the butt, because corporates don't have compliance teams. It's great for banks and for people who've got compliance teams. Super, you've got people that can run away and tick boxes. For corporates, it's a complete pain. So when they're looking at solutions, that's another consideration. How much pain am I going to have to go through to get the perceived benefit from doing this?
I love it. Compliance is a pain. You lot can keep.
I'm sure that's not new news.
No, that's right.
Respond to Swarup's question.
I was going to the audience. Go on,
Okay.
Chris.
No, he's right. Look, I didn't mean to say securitization is the only tool, but it's an important tool, particularly when it comes to, there's a range of levers, right? I would look at. The only reason I address securitization because it's very important for it to come back. The other, as he himself said, and we work together on other instruments, it is there, but scaling is difficult.
But Sarah is going to say to you, do I need this? Are you really going to take me through this hassle? Anyway, audience, anything taking your fancy before I...
Hi, I've got to agree on BAL 1, 2, 3, 4. Steadily there's been an erosion of regulatory recognition of trade finance. And one of the challenges with that is that banks themselves have not been treating trade finance and trading the way they should. And if you look at the data we get now from people like TXF, which is a very valuable source, the huge numbers in the data for commodity trade finance come from these unsecured revolving credit facilities, which are straight corporate lending. And this skews the data, this skews the regulatory view. There is now no regulatory recognition of collateral. And because there is no regulatory recognition of collateral, banks will not spend the money to monitor it and check it. And if they do it, they outsource it to somewhere where nobody cares. 2 months after I left Deutsche Bank, they shut down my middle office and back office, kept for 20 years in Amsterdam, and they used that headcount to India. And they sold it to the team as an upgrade and said, all these Indians, so they're all MBAs, they're all much more highly qualified than these Dutch guys you had who didn't have a degree between them. Well, no, they didn't, but they had 30, 40 years experience between them, or each of them. It took them 2 months to lose money because they didn't do something on time. And there's this sort of false economy in banks with cutting costs, also because there's no regulatory recognition. And then we're all surprised that trade finance doesn't work. It does work, but you've got to do it properly. And then the question is, how can you do it properly?
Yeah, I think the explaining of trade. Anybody else before we go back to the panel?
No, absolutely agree with you on collateral because we see it at GCD, we run the collateral, the cash flows. Just one thing, the PRA has changed the regulations. Earlier, they never used to recognize fixed charge. Under Basel III, a floating charge on working capital will be recognized. Now, not many people realize this, but it is one small step, I would say, in actually looking at collateral in a proper manner. Most often it is banks' legacy systems where you don't have lineage and control. So a lot of it is to do with coming back to IT systems, legacy systems. If you link it, you're absolutely correct. I 200% agree. You need that collateral. And I will simply also say very few banks, and you will know this better given your experience, like you have a PD rating system, very few banks have an LGD rating system. That was a fundamental flaw 20 years. Still, I don't see that being rectified. Some banks do. We can have a conversation after.
This one, on the regulatory point, I think this is where the role of bodies like ITFA becomes enhanced, on where we are both working on education with the clients, with the customers, as well as with regulators on how to get more guidance on some of the regulatory treatment that can help the industry. So we are actually currently working on some of these through our institutional investors committee. So happy to discuss this and take up any topic you like. On the point of origination, you mentioned on controls, and this was the point I was referencing. So I actually see the room. So she spoke about origination, spoke about the future, and he's talking about the tomorrow on how do we create. So actually, if you think of today and tomorrow, so it's all the same points.
No, that's right. But I think, with all different due difference to Mac. Let's leave the banks to one side. Let's leave Basel to one side, because my view is the regulators got it wrong. But we're talking here about an investable class. We're talking about non-banks, funds and whatever, who actually say, well, look, I don't care about what this regulatory stuff was all about. Is my investment secure? Is my structure?
How many of those funds have failed in the last 5 years?
How many of the funds have failed in the last 5 years?
Many of them. There's a litany of funds, of trade finance funds, who failed in the last 5 years.
Perhaps they weren't doing trade finance. Perhaps they weren't doing trade.
They don't understand trade finance, but they want their
They
high
want,
interest.
but this is the discussion. In fact, the idea is, Sarah was asking for it, educate what you need in order to have an investable asset. Tell the corporate what they've got to do, instead of, with all due respect, banging on about what the regulator may or may not want to say, because we can create the asset class that somebody will want to invest in by making it better. Sorry, you were...
Hi, great panel, and I think really timely discussion. Just to piggyback off what Sarah has said, I think we go to a lot of these trade finance conferences, conversations, and we're all trade finance experts. Within the room, I think we all probably have different views of what is trade. I mean, you mentioned open accounts. Most of the trade in the world today is open account, for example, but there's a lot of products and sometimes using different financial tools that are not trade finance to actually address working capital. So within the experienced trade finance space, there isn't a lot of clarity on what do we mean by trade and these trade assets. So it's not super surprising that the corporates themselves are not very clear about what it is we're talking about, nor the regulators. And we're talking now at the larger corporates. So of course, if we're now looking at some of the SMEs and going to emerging markets, it becomes a bit more, I wouldn't say there's less trade, it's just that trade looks like so many different things. We could also be talking about the same thing but using different words. And I know we've had a lot of initiatives around defining trade products, but I think that I'm curious to hear what your thoughts are around how do we have clarity even within our ecosystem of trade finance experts, and how do we promote that as kind of the standard of what it is that we mean, so we're very clear about what the product is, what it's for, who it's for, and what's the general purpose of this whole discussion.
Well said, yeah.
I think a lot of work has been done. See, the ICC, ITFA and all that. I know there's supply chain finance where they actually went into the structures. The document is available as to what these products mean. Also, the trade register, at least in the past, has defined what are traditional trade products and what is covered. So it's a good starting point in terms of the definitions, and I know if I leave Swaroop to talk about it and to my lawyer friend here, because structures have been defined.
But it's a continuous process.
But you define it amongst banks. We don't tell the corporates what we want to define. I think, Sarah, that was your point, isn't it?
No, absolutely. I completely agree with the point that was being made, is that whether you're a corporate or actually operating within the profession of trade finance, let's call it, that clarity and consistency about what do you actually mean by open account, or what do you actually mean by securitized product, and having a consistent definition would be incredibly helpful, certainly when it comes to talking to corporate, because you just don't know. You can have a conversation with one person and they mean one thing, and they use the same word, but they mean something slightly different.
I think you made Jeff's day. Go on. But I do agree it's a very difficult challenge because the universe is also expanding, to your point.
Yeah.
On what we used to call, it started with goods trade. We now do a lot of services trade. And then also we are having new propositions around embedded finance and digitized products, etc. So the universe is continuously expanding. It's not a finite process of we are done. But I think there is a space for us to educate, and there will be deviations. Recognize the nuances of market. Being in a global institution, we see this every day. The way you operate in a particular market is probably not a way you can operate in another market. So you will have local nuances. But I think there is a need, and this is part of the work we're trying to do on defining what is to institutional investors, but I think there's a lot of work to be done on the origination side as well, to be able to say this is how trade finance operates. Yeah.
But to your point, Jeff, about we should be talking to the corporates about how to make the assets more attractive, surely that only gets us so far. I mean, it isn't really, to Mac's point, talking about funds that are failing, banks that have had losses. Isn't it just the finances have to get the nuts and bolts of doing traditional trade finance correct, do the monitoring,
correct,
have those robust structures?
That's what you talk about, traditional trade finance. I'm talking about traditional trade, which gets financed. So it's a trade that gets financed. I mean, Mac's point in some ways is right. If you say, I do trade finance because I lend in a 3 billion revolving unsecured facility, that's not trade finance. That's not what I wanted to talk about. That's not the asset class that the investor wants. One, because the return's not big enough, not good enough. So if we're looking at the investor, and Christian, you were talking about this sort of mixed structuring, but ultimately what underlies the structure is trade, is a trade transaction. And I think the message back to the corporate is that what they want to finance is a trade transaction. So that's good news. We can talk about it's a working capital solution, but it's a solution based on the fact that you've got a trade. And that trade is that you buy and sell goods, you provide services. Isn't that really what we want? In order to make the class what we want, it has to have an underlying corporate and commercial transaction.
It has to have commercial transaction. It has to have the right level of controls and monitoring, and that is where this breaks, right? In opportunism, you often skip the step of having and say that this is not essential. And you only recognize the value of that in difficult times. So having the right structure, having the right controls, that's an infrastructure. That's the key.
Right. I think to your point in terms of the actual trade finance, the way and maybe it's simplified, but the way I see it is anything that could be covered by a true sale legal structure. It could be inventory, it could be a receivable, it could be a payable, but anything that could be purchased as an asset under the true sale structure. That does not go into the bankruptcy court, like in the US, for example. No regulators cover this market in the US, for example, with a true sale structure.
That covers a small universe of trade finance, I would still say. There are lots of lending products which are in trade.
But that's $2.5 trillion worth of true sale structures. Audience, anything more? I'm going to ask the panel, I don't have time for the panel to have 1 minute each, just final thought summary. Anybody else in the audience got anything to add to this? Right, good, okay. You've almost done. Do you want to add anything more to that great summary you just did?
Sure. I think a point to someone's comment earlier in terms of trade finance funds. We had a couple of hedge funds last year in the US raising billions of dollars. And guess what? Hundreds of millions of dollars were lost last week. So we'll see what the investigation brings, whether it's fraud, whether it's mismanagement, whether it's just structural issues. We shall see, but this is something to be tackled. The issues of fraud, the issues of data transparency, and the issue of underwriting and live monitoring and technology innovations in terms of live view of that process are super crucial for this to be successful.
Perfect, thank you. Sorry.
Yeah, I would emphasize on the point of driving origination and value for customers, bringing right controls and infrastructure to support it, and developing new products for the future, leveraging technology and underwriting using data. So the embedded finance point. I think these are three things which could really drive. Underpinning all of this is the education point, which we have been working on both sides, on all the ecosystem players, which is investors, originators, and corporates.
Thanks. Christian?
I'd just say securitization was only one tool. There is a paraphernalia of tools or levers which should be used, but when it comes to scaling up, it's an issue of risk returns, because many of the capital markets investors are looking at returns which are 10% plus. That's where, when you look at the origination pricing, even at the sub-investment grade, it sort of fails. And you do have the issue, whether it is securitization or an ABCP replenishment, because these are short-term structures where the challenges lie, right? And on just one point on the bankruptcy, on the default case, which we are seeing in the US, it surprises me. This was on invoice financing, having looked at factoring and with insurance companies, that something really went wrong. This could not have taken place. Simple point. Why was a double B company being lent 100% of those invoices? Because normally in invoice financing, advance rates always come out. This did not happen overnight. There were people who understood. 3 insurance companies have lost money. having looked at this in very great detail in my last job, something went wrong badly. No credit, default happens overnight. Hindsight is wonderful. We will make.
Good point. Matthew.
What I would take from the discussion is really the point about, is there more that financiers can do working with the borrowers to look at their trading activity and make that trading activity more amenable to financings. It seems most financiers tend to leave the borrower's existing trading lines in place and then just plonk a financing on top. But I guess the more that there can be interaction between the financier and the borrowers to make the trade activity as transparent as possible, that will certainly help the financings.
Sarah, what's your takeaway for this one?
I think it's just proved that it's a useful product to the corporate.
Needs to be explained.
Okay, guys, prove it's useful. Prove that the trade finance that you're offering, the product, is useful to the corporate. Educate the corporate. I think that's a fairly good message for many of us involved in the room. We've run over very slightly. I didn't get a sort of, have I got a, yes. Okay, everybody. Thanks for your attention. Panel, thank you very much for, I hope, a useful discussion.
And don't forget to follow Trade Treasury Payments
on your favorite podcast platform.
Thanks for listening.